Hello friends, so let's start a new question 37. Students, this question is there in the old practice manual. It came in November 2013 paper for 8 marks and May 2008 paper for 10 marks. Students, one thing I want to tell you about this question is question 37, 38 and 39. These three are a group of similar type of questions and they have to be solved in a typical similar fashion. Students, so please pay attention and please understand this fashion, this mannerism in which we have to solve these questions is as per ICAI only. Okay, so let us start understanding what is special in these three questions of the same type. Can we start? So students, now I would request everyone to pause the video here and read this question carefully. Okay students, so I hope you all have read the question. Let us try understanding what it is all about. A holds the following portfolio: Epsilon Limited, Sigma Limited, Omega Limited, Government of India bonds. Beta is given. Initial price, that means P0 is given. Dividends means basically D1 is given. Market price at the end of the year means P1 is given. They are saying calculate, point number 1, expected rate of return using CAPM. Students, that means we have to calculate KE for each of the 4 stocks, correct? First things first, for KE, according to CAPM, what data is required? Can I say first of all IRF is required, which is available at 14%. What is not available in such type of questions is the RM. And you know what ICAI does to calculate RM? It considers this whole group of securities in your portfolio to be representing the market. Okay, so basically this whole thing is the market. The actual return of this whole thing becomes the RM for calculating KE. Students, let us now understand how ICAI calculates RM by considering this whole table as the market. Can we start? Okay, so question 37, point number 1. To calculate CAPM, the first thing I'm doing is calculation of RM. Very simple. It says P0 is equal to, for RM the P0 is equal to, straight away add these 4 numbers, okay, because the total is the market, so total of P0s will become total P0 for the market, that is 25 plus 35 plus 45 plus 1000. So I'll write down here 25 plus 35 plus 45 plus 1000. If we take the calcies, 25 plus 35 plus 45 plus 1000, we get 1015. So I'll write down here 1015 becomes the P0 for the market return. D1, very simple. D1, can I say we'll take total of 2 plus 2 plus 2 plus 140. So I'll write down here 2 plus 2 plus 2 plus 140, which is equal to 146. And next, students, P1 equal to, students, as far as P1 is concerned, it will be the total of these 4, that is 50 plus 60 plus 135 plus 1005. Okay, 50, 60, 135, 1005. So I'll write down here 50 plus 60 plus 135 plus 1005. Students, if we take the calci, 50 plus 60 plus 135 plus 1005, which is equal to 1250. So students, now we have total P0, total P1, total D1. Let us calculate RM. I am very sure you all know which formula is to be used now. Yes, RM is equal to P1 minus P0 plus D1 upon P0 into 100. This is a typical way of calculating RM in such types of questions. Okay, so I'll write down which is equal to 1250 minus 1105 plus 146 the whole divided by 1105 into 100. My RM comes to, let's take the calci, 1250 minus 1105 plus 146 the whole divided by 1105 into 100 will give me 26.33%. So I get my RM as 26.33%. Yes, so with this we have calculated the RM. Now we can go ahead and calculate KE for each of the 4 stocks. Students, what is the formula of KE? KE is equal to IRF plus RM minus IRF into beta, correct? Students, the IRF we already have is 14% and RM we just calculated was 26.33%. So I'll write down here which is equal to 14 plus 26.33 minus 14, into the beta, which is equal to 14 plus, students, 26.33 minus 14 is obviously 12.33 into beta, correct? So students, with this we get the KE formula. Let us now substitute the beta of individual stocks here and get KE for all of them. Students, so let's calculate KE for the stocks. First one is epsilon. Yes, next is sigma, next is omega, and next is GOI bond. So epsilon, sigma, omega, and GOI bonds. Let's start. So KE will be equal to 14 plus 12.33 into the beta of epsilon. KE will be 14 plus 12.33 into the beta of sigma. KE will be equal to 14 plus 12.33 into the beta of omega, and KE is equal to 14 plus 12.33 into the beta of GOI bonds. Students, let's go for epsilon now. In epsilon, what is the beta? 0.8. Next, sigma, beta is 0.7. So I'll take here 0.8, 0.7. The next two students is 0.5 and 0.01. So I'll take here now 0.5 and 0.01. Let's take the calces now. 12.33 into 0.8 plus 14 will give me 23.86%. 23.86%. Next one, students, 12.33 into 0.7 plus 14 will give me 22.63. So I'll write down here 22.63%. The next, students, is 12.33 into 0.5 plus 14 will give me 20.17%. 20.17%. And the last one is 12.33 into 0.01 plus 14, that is 14.12%. Yes, 14.12%. Students, with this we complete the first point that they asked, expected rate of return using CAPM. Let us now do the second one, average rate of return on his portfolio. Students, average rate of return on his portfolio will be nothing but a simple average of these four, assuming that he has invested equal amounts of money in each of the four securities. So therefore, my RP will be return of the portfolio. Do you realize that if the weights are same, if the proportions are same, RP can be nothing but a simple average. We need not do the weighted average. So can I say it is 23.86 plus 22.63 plus it is 20.17 plus 14.12, the whole divided by 4. Let's take the calci. 23.86 plus 22.63 plus 20.17 plus 14.12, the whole divided by 4 will give me 20.195% as the return, average return of the entire portfolio. Students, apart from this, there is one more method to calculate RP of the portfolio. I'll write down OR. Students, see, please pay attention. Step 1 is to calculate beta of the portfolio. That is nothing but average beta. Average beta means, students, do you realize if this is my portfolio, my average beta will be nothing but simple average of these four betas. Okay, so I will do average beta is equal to 0.8 plus 0.7. So I'll write down here 0.8 plus 0.7 plus, students, the next two is 0.5 plus 0.01. So I'll write down here 0.5 plus 0.01, the whole divided by 4, the whole divided by 4. So if you take the calces, 0.8 plus 0.7 plus 0.5 plus 0.01 divided by 4, my average beta, students, comes to 0.5025. My average beta is 0.5025. This is the average beta of the portfolio. So can I say KE for the entire portfolio, return of the entire portfolio will be IRF plus RM minus IRF into the beta of the portfolio. If we want KE of an individual security or a portfolio, just take the beta of that individual security or the portfolio. Can I say it is 14 plus 26.33 minus 14 into 0.5025. Students, if we take the calci, it is 26.33 minus 14 into 0.5025 plus 14, we will get 20.19%. Yes, 20.19%, which we had got earlier also. 20.195. Students, even this is 20.195 itself. Yes. So students, this is another method of calculating average return of the portfolio simply by calculating your average portfolio beta and straight away putting it in the CAPM formula. Okay students, so I hope you understood point number 2 and therefore question 37. Let's now do question number 39. Students, this question is also there in the old practice manual. November 2005 paper, it came for 8 marks, and May 15 paper, it also came for 8 marks. Students, I would request all of you all to pause the video here and read the question once, please. Okay students, so I hope you all read this question. You might be feeling, sir, similar question, why again you have put? No, there is something tricky here, some twist is there. Let's see how. Your client is holding the following securities. Basically is holding gold, silver, bronze and GOI bonds. Cost means basically students, what has been given is your P0. Students, dividends and interest means basically your D1. Market price at the end, basically this will be P1, and then betas are given to you, correct? Now they are saying average return of the portfolio is 15.7%, which means in this question they have already given to you the average return of the entire portfolio. Now they are saying calculate point number 1, expected rate of return in each using the CAPM. I think now you will say, sir, it is very simple. By calculating this entire table, we can get the RM, and then IRF already not given to us. It is not given to us. Look at the question. IRF is not given to us. In fact, they have asked us in point number 2 to calculate the IRF. They have asked us in point 2 to calculate IRF. Students, in this situation, what to do? Very simple. Do you realize this will be taken as the KE of the entire portfolio? We can easily calculate RM of this particular question. RM is available, KE is available. We can easily find the average beta here and then calculate the IRF as the balancing figure. I hope you understood what I'm trying to explain. Yes, I'll again repeat students, you have been given the KE of the portfolio. We can easily find the beta of the portfolio. We can easily find the RM. Using this data, we will easily be able to find IRF that they are asking in point number 2. Can we start students? Okay students, so now my entire goal and focus first is to calculate IRF. Students, I'll write down here calculation of IRF, that is the risk free return. Can we start? So first things first, let's calculate RM. Students, for RM, we will need the P0, we will need the D1, we will need the P1. Yes, can we start? So P0 will be 10,000 plus 15,000. I'll write down here 10,000 plus 15,000. Okay, 10,000 plus 15,000 plus 14,000 plus 36,000. So I'll write down here plus 14,000 plus 36,000, which is equal to 10,000 plus 15,000 plus 14,000 plus 36,000. We will get 75,000 as your total P0, correct? Next, as far as D1 is concerned, students, D1 will be 1725 plus 1000. So I'll write down here 1725 plus 1000 plus the next two are 700 and 3600. So I'll write down here 700 plus 3600, correct? So let's take the calci now. 1725 plus 1000 plus 700 plus 3600, which is equal to 7025. Your total dividend of market return is 7025. Let's now go for P1. Students, P1 will be 9800 plus 16200. I'll write down here 9800 plus 16,200 plus the next two are 20,000 and 34,500. I'll write down here 20,000 plus 34,500. Let's take the calci students. 9,800 plus 16,200 plus 20,000 plus 34,500. If we do, we will get 80,500. Okay, we will get rupees 80,500. Students, let us now calculate RM. Can I say my RM will be P1 minus P0 plus D1 the whole upon P0 into 100. So it is 80,500 minus 75,000 plus 7025 the whole divided by 75,000 into 100. So if I take my calci, 80,500 minus 75,000 plus 7025 divided by 75,000 into 100, I get my RM now as 16.7%. Yes, I get my RM as 16.7%. Students, now we got RM. Let us calculate beta of the portfolio. Can I say my average beta will be, 0.6 plus 0.8. I'll write down here 0.6 plus 0.8 plus it will be 0.6 plus 0.01. So I'll write down here plus 0.6 plus 0.01 the whole divided by 4. So if I take the calci, 0.6 plus 0.8 plus 0.6 plus 0.01 whole divided by 4, we will get average beta as 0.5025. We'll get average beta as 0.5025. Which students we can round it off to 0.5 times. Okay, on an average 0.5 times is the portfolio beta. Students, let us now calculate KE. What is the formula of KE? KE is equal to IRF plus RM minus IRF into beta. We want the KE of the portfolio, so we'll take beta of the portfolio. But here the KE of the portfolio is already given as 15.7%. So let us put the numbers now here. 15.7 is equal to IRF is what we are searching for. RM is something that we got as 16.7%. So I'll write down here plus 16.7 minus IRF into the beta of the portfolio, which we got as 0.5 times. So I'll write down here into 0.5. Ready? Let's start. 15.7 is equal to IRF plus, students, 16.7 into 0.5. If I do 16.7 into 0.5, I will get 8.35. So I'll write down 8.35 minus 0.5 IRF, okay, minus 0.5 IRF. Now this 8.35 I will take to the LHS. So 15.7 minus 8.35 will give me 7.35 on the LHS. So 7.35 is equal to IRF minus 0.5 IRF, which is equal to 0.5 IRF. Therefore, my risk-free return, that is IRF, will be 7.35 divided by 0.5, that comes to 14.7%. Yes, 14.7%. With that, students, my point number 2, risk-free rate of return has been calculated as 14.7%. Now the last point, that is actually point number 1, expected rate of return in each of these securities using CAPM. Very simple. Let us calculate KE for each of these 4 securities. Let's start. Okay, point number 1. KE is equal to, tell me KE is equal to IRF plus RM minus IRF into beta. My IRF is 14.7. My RM, students, is 16.7. So I'll write down now here 14.7 plus 16.7 minus 14.7 into beta, which means my KE is nothing but 14.7 plus 2 beta. Let's now calculate for each of the stocks: gold, silver, bronze and GOI bonds. So I'll write down here gold, silver, bronze and GOI bonds. Okay, so KE for gold will be 14.7 plus 2 into its beta. KE for silver will be 14.7 plus 2 into its beta. KE for bronze will be equal to 14.7 plus 2 into its beta, and KE for Government of India bonds will be 14.7 plus 2 into its beta. Let's take the number, students, of the betas. 0.6, 0.8. So I'll write down here 0.6, 0.8. Okay, the next 2 betas given to us are 0.6, 0.01. So I'll write down here 0.6, 0.01. Let's now complete this, students. Let's take the calci. 2 into 0.6 plus 14.7 will give us 15.9%. 15.9% will be the KE for gold. KE for silver, 2 into 0.8 plus 14.7 will be 16.3. So I'll write down here 16.3%. Next students, 2 into 0.6 plus 14.7 will give me 15.9%. Again, 15.9% is the KE for bronze. Both bronze and gold will have same KE because both have same betas as 0.6. And the last one, Government of India bonds, 2 into 0.01 plus 14.7 will give me 14.72% for the GOI bond KE, correct? Okay students, so with this we get the individual expected returns for each using the CAPM model. Students, before I end this question, one thing I want to tell you here is, can you see this beta calculation we did here, average beta? Yes, we took the simple average, right? We took the simple average beta. Students, even the ICAI in its practice manual has also taken the simple average only. Students, but we could have alternatively in this question, because the investment amounts were given, we could have taken the weighted average beta because the weights of each of these investments are different. Students, here I will stop the solution at simple average beta only because right now I have not taught you portfolio beta. In a further module, you can see there is a module called as portfolio beta. In that portfolio beta module, students, I will be teaching you how to calculate portfolio beta. That is nothing but the weighted average. Weighted average means I'm very sure you know how to do this. You have the amounts of investment, you can easily calculate the weights, and that weights into the beta, you will get the weighted average beta. Students, once that portfolio beta module is done, you can revisit this question if you want and recalculate the weighted average beta instead of the simple average and recalculate this question. Students, I am right now stopping here because this is the ICAI solution. No need to actually go into the portfolio beta as of now. I hope you understood the solution to this particular question, question 39. Question 92. Students, this question I have picked up from the old practice manual. It has also been asked in June 2009 paper for 6 marks. Okay, let us read together only. An investor has 2 portfolios known to be on minimum variance set for a population of 3 securities A, B and C having below mentioned weights. So they have given you portfolio X, they have given you portfolio Y, weight of X, weight of B and weight of C. So what they are saying is that there are these 2 portfolios X and Y which are to be understood to be minimum variance portfolios, and in that X and Y, the proportions of A, B and C. So basically X and Y are portfolios, A, B and C must be securities. The weights are given. In portfolio X, the weight of A is 0.3, weight of B is 0.4, weight of C is 0.3. In portfolio Y, weight of A is 0.2, weight of B is 0.5, weight of C is 0.3, and they say that these portfolios lie on the minimum variance set, which means these have the least sigma p. Let's go ahead. It is supposed that there are no restrictions on short sales. That's okay. Point number 1 we'll complete first. We'll read it quietly. Listen carefully. What would be the weight for each stock for a portfolio constructed by investing 5,000 in portfolio X and 3,000 in portfolio Y? So they are saying that if I invest 5,000 here and 3,000 here and create a new portfolio of X and Y, in that new portfolio, what will be the weight for each stock? Okay, what will be the weight for each stock, meaning WA, WB and WC? How much will it be in this new portfolio? Can we start solving this very simple mathematical based question, students? Let's start. So I'll write down here question 92, point number 1. Okay, so let us first put the data. There is this new portfolio. Okay, there is this new portfolio. New portfolio consists of which 2 portfolios? Portfolio X and portfolio Y, correct? Portfolio X and portfolio Y. Students, what is WA, WB and WC in portfolio X? So A, B, C weights are, in portfolio X it is 0.3, 0.4 and 0.3, correct? So I'll write down here 0.3, 0.4 and 0.3. As far as portfolio Y is concerned, students, it is 0.2, 0.5 and 0.3. 0.2, 0.5 and 0.3. So I'll write down here 0.2, 0.5 and 0.3. Okay, children, now tell me, what are you investing in X? They are saying you're investing 5,000 in X and 3,000 in Y. Okay, so you are investing 5,000 in X and 3,000 in Y. Students, do you realize now, if you are investing 5,000 in X, what will go in security A? Do you realize 5,000 into 30%? 1,500 will go in security A. 5,000 into 40%. 2,000 will go in security B, 5,000 into 30%, 1,500 will go in security C. This is your total 5,000 which you invested in portfolio X, which went in these respective shares. Let's see what happens in portfolio Y. We have invested 3,000 in portfolio Y. Therefore, 3,000 into 0.2, 600 rupees will go in security A. 3,000 into 0.5, that is 1,500 will go in security B. 3,000 into 0.3, 900 rupees will go in security C. This is your total 3,000 invested in portfolio Y, which has gone in these proportions in A, B and C. Students, now if you see the last part, come on. If I want to know how much I have invested total in security A, B and C, let me take the amount, students. So amount total invested in security A through portfolio X and Y will be 1,500 plus 600, that is obviously rupees 2,100. The next one, for security B, my investment is 2,000 plus 1,500, that is 3,500. And for security C, it will be 1,500 plus 900, that is 2,400. Students, if we take the total, we will get, of course, rupees 8,000. That is nothing but 5,000 invested in X and 3,000 invested in Y. So students, now let's calculate the weights. 2,100 divided by 8,000 will give you 0.2625. 3,500 divided by 8,000 will give 0.4375, and the last one, 2,400 divided by 8,000 will give 0.3. Total is 1. Total is 1. I hope you understood this particular question, students. Point number 1 is done. Now they are asking in point number 2. Please pay attention, okay? Let's start. Suppose the investor invests 4,000 out of 8,000 in security A. How will he allocate the balance between security B and C to ensure that his portfolio is on the minimum variance set? So he is saying he is creating a new portfolio Z in which he has already decided to invest 4,000 out of 8,000, which means he has 8,000 to invest. Of that 8,000, 4,000 is investing in security A, which means, do you realize that 0.5, the weight of A in this new portfolio Z is 0.5, that is 4,000 out of 8,000. Students, they are asking you what should be the balance allocation between B and C. What should be the weights of B and C so that the portfolio is on a minimum variance set? Okay, students, let's start the calculations. Very simple it is. See, please pay attention. There are these securities A, B and C, and the weight of A is already decided as 0.5, which is nothing but 4,000 divided by 8,000. Okay, 4,000 divided by 8,000. Students, they are asking you what should be the weights of B and C so that the portfolio continues to remain on the minimum variance set. Continues to remain on minimum variance set. Students, can you see that portfolio X and Y, see, they have not given us much data about the minimum variance, the sigmas, etc. Only weights are given, correct? But one thing you can notice in this is that whenever the portfolio lies on a minimum variance set, the weight of C is fixed. that is 0.3. The weight of C is fixed, that is 0.3. Therefore, students, the simplest of all calculations can be that even if I make a new portfolio now, and if it has to be on a minimum variance set, the weight of C will continue to remain 0.3. The weight of C will continue to remain 0.3, even if you notice when you had created this new portfolio in which you had invested in portfolio X and portfolio Y, can you see that the weight of C continues to remain 0.3, which means in this new portfolio also, if it has to lie on the minimum variance set, portfolio C's weight should be 0.3. Therefore, as a result, the balancing figure of security B's weight will be nothing but 0.2. Therefore, the balance should be allocated between B and C in the weights of 0.2 and 0.3. Students, very simple question this was. But if you want a mathematical explanation for this, I can give you like this. See, please pay attention. Do you remember characteristic market line, beta, alpha, everything you remember, right? Okay, I hope you remember. See now, please pay attention. That linear equation explanations I had given you will now come into picture. Students, do you understand that for a portfolio to lie on a minimum variance set, C is not cooperating. It says whatever you want to do, my weight is going to remain 0.3 only. Therefore, do you realize A and B, they fluctuate, and here I am assuming that they fluctuate based on a given relationship between A and B. That means when weight of A is this, weight of B should be like this. When weight of B is this, weight of A should be like this. So these two I am assuming are having a linear relationship between both of them. Let us find out what that linear relationship must be. Because students, weight of C has no relationship with anybody. It is fixed. It is saying I am 0.3. You want to remain on the minimum variance portfolio, I am 0.3. Please, you both only settle amongst yourselves. And therefore, if I want to know how A and B, how weights of A and B settle amongst themselves, I need to know the relationship between weight of A and weight of B, assuming there is a relationship between them. Students, now for the purpose of relationship, I will take the help of a linear equation between both of them. Can we start understanding, please? Let's start. Okay, students, so I have removed all the markings now. Please pay attention. Do you realize that if I want to know the relationship between WB and WA, that is how WB reacts to a movement in WA, I will need to know the two constants beta and alpha. Okay, I will need to know the two constants beta and alpha, which we will have to solve simultaneously. Let us see how. Okay, students, so now let's take portfolio X. Okay, let's take portfolio X. In portfolio X, I am very sure you know that we have the WB and WA with us. So let's create that equation. Students, what is WB and WA in portfolio X? Can you see WB is 0.4, WA is 0.3, okay? WB is 0.4, WA 0.3. So I'll write down here 0.4, okay? This is WB. WB equal to beta into WA plus alpha, correct? Beta into WA plus alpha. Students, we can rewrite this as 0.4 is equal to 0.3 beta plus alpha. This becomes your equation 1. Students, as far as the portfolio Y is concerned, you can see WA and WB 0.2 and 0.5. Okay, so can I write that WB is equal to WA into beta plus alpha, correct? WB was 0.5, WA is 0.2, and WB is equal to beta into WA plus alpha. Yes, so the numbers are now put. This obviously becomes equation 2. Students, how should I now solve them simultaneously to calculate the beta and alpha figures? Straight away we can do 1 minus 2, the alpha will get cancelled, we can find out the beta. Okay, so if I now do 1 minus 2, okay, see what happens. 0.4 minus 0.5 will give minus 0.1 is equal to 0.3 minus 0.2 will give 0.1 beta, and alpha will get cancelled. Can I say therefore my beta will be minus 0.1 divided by 0.1, which is minus 1. Students, with this we understand that the beta between weights of A and B is -1. Using this beta, we can now calculate the alpha. Students, I hope you understand this beta is not that systematic risk indicator. This beta is just the slope, the regression coefficient, which I am calculating just to find the relationship between WA and WB. Okay, students, so let's go ahead. Yes, the beta equal to -1 means basically here the dependent variable WB reacts -1 times to a change in WA, which means if WA goes up by 10%, WB will react opposite but same -1 time, no? So WB will go down by 10%. Okay, that is the meaning of beta between WA and WB being -1. Let us now substitute this in any equation to find out alpha. Students, in equation 1, if you see, 0.4 is equal to 0.3 into beta. Students, beta I will take as -1 plus alpha, correct? Plus alpha. This was equation 1 where I have substituted beta equal to -1. Students, therefore, 0.4 is equal to minus 0.3 plus alpha. Can I say my alpha will be 0.4 plus 0.3, that is 0.7. My alpha is 0.7. Students, now we have got the beta and alpha. Do you understand that now this particular equation can be now put into use properly? Can I say WB is equal to, what is the beta we got, students? Beta we got is -1. So I'll write down here WB is equal to -1 WA plus how much alpha we got, students? Alpha we got is 0.7. So I'll write down here plus 0.7. Therefore, WB is equal to 0.7 minus WA. WB is equal to 0.7 minus WA. Now students, this is the new linear equation that we calculated that shows the relationship between WA and WB, that whenever WA and WB fluctuate on the minimum variance portfolio, they tend to have this relationship that WB is equal to 0.7 minus WA. Students, if you check here, WB is how much? 0.4. Students, WB is 0.4 here. They are saying WB will always be 0.7 minus WA. Can you see 0.7 minus WA? 0.7 minus 0.3 will give you 0.4. Second case, can you see WB is 0.5? Can you see, students, that WA here is 0.2? 0.7 minus 0.2 obviously will give you 0.5. That means WB does follow the equation 0.7 minus WA. And now in this question, if they are saying that WA, students, WA is going to be 0.5. They are saying WA is going to be 0.5. So what do you think will be WB? Do you realize if WA is going to be 0.5, then WB will be 0.7 minus 0.5, that is 0.2. 0.7 minus 0.5, that is 0.2. So therefore, students, I can write down here your WA given in the question was 0.5. WB that you just calculated is 0.2, and therefore WC as a balancing figure, total of the weights has to be 1, will be 0.3. Yes, WC will be 0.3. So 0.5, 0.2 and 0.3 are the new weights for your new portfolio. If you have already decided to put 0.5 in WA, therefore the balance amount should be allocated between WB and WC in the ratio of 0.2 and 0.3. Students, I'm very sure you remember we had got that WB and WC 0.2 and 0.3 earlier only by understanding that weight of C is fixed at 0.3. Weight of C is fixed at 0.3, so the weight of B has to be the balancing figure, that is 0.2. Also, you can see this. Do you understand? Weight of C is fixed 0.3. Therefore, do you realize that WA plus WB has to be 0.7, right? WA plus WB has to be 0.7. Therefore, WB has to be 0.7 minus WA. WB has to be 0.7 minus WA. Students, this simple equation WB is equal to 0.7 minus WA. So much hard work we did by doing all these linear equations calculations, and then eventually coming to that same conclusion that WB is equal to 0.7 minus WA, which we could have got just by understanding simply that weight of C is fixed at 0.3. Yes, so students, I will also conclude this by writing down here security, amount and weights. Okay, students, A B and C. The total you're investing is 8,000, weight is 1, of which 4,000 already you have invested in A, the weight is 0.5. We have understood that the remaining weight should be 0.2 and 0.3. Therefore, what should be the allocation? So now the balance, students, please understand, 8,000 into 0.2, 1,600 you should invest in security B, 8,000 into 0.3, 2,400 you should invest in security C, and with this we complete our family, we complete this particular portfolio. Students, I hope you understood this miscellaneous question. Miscellaneous in a sense, I have named this module as miscellaneous. This question 29 which came in June 2009 for 6 marks. So let us now see one more question, question 93. Students, have picked this question from the old practice manual. Yes, I request everyone to please pause the video and read this question very carefully. Start. Okay students, I hope you all understood me. Okay students, I hope you all read the question. Let me now explain it to you. Following information is available in respect of dividends, market price and market condition after 1 year. So they're saying in this year the market condition can either be good, normal or bad. The probabilities are given to you. That means I am very sure you know what this is. 25% chance that good will happen, 50% chance normal will happen, and 25% chance that bad will happen. Market prices are given to you, which means P1 can either be 115, 107 or 97. D1 can either be 9, 5 or 3. Yes, the existing market price of an equity share is 106, face value is 1, which is 10% cum bonus debenture of 6 each per share, which means they're saying that in this equity share there is also an embedded debenture there, okay, which means they are saying that this 106 if you pay, you are getting not only an equity share but also a 6 rupees worth debenture. Can I say, as far as equity share is concerned, the P0 that I will take, today's market price won't be 106, it will be purely 100 only, the value of the share alone. 6 rupees is the value of the debenture, correct? X Finance Company has offered the buyback of debentures at face value. Students, regarding this buyback, I'll explain later. Now let's read ahead. Find out the expected return and variability of returns of the equity share. Students, they're asking you basically X bar and sigma X. How simple this is. How many times you have done this? Can I say P1 minus 100, that is P0. I'll write down here P0 is 100, right? So P1 minus P0 plus D1, the whole upon P0 into 100 will give you X. The probability is 0.25. Then P1, that is 107 minus P0 100 plus 5D1 upon P0 into 100 will give you the other possibility of X with a probability of 0.5. Next P1, that is 97 minus P0, that is 100 plus D1 3, the whole upon P0 into 100 will give you the other possibility of X whose probability is 0.25. We have the probabilities, we have the X. Can we find X bar and sigma X, students? We have been doing this day in and day out since the time portfolio started. In fact, since the initial modules only we were doing this. So nothing much in this particular case, right? Students, what you have to only understand in this case is advice whether to accept the buyback or not. Okay friends, so before I explain to you this buyback thing, that is this bracket here, let us first calculate the X bar and sigma X of this equity share, correct? Students, I'm very sure you understand this is P1 given to you, this is D1 given to you, and your P0 is 100, right? Not 106. Ready? So let's start. So question number 93, first part, students, calculation of X bar and sigma X, okay? Students, X bar and sigma X, for that I will need the 3 possible levels of X, correct? Students, what are the 3 market conditions? Good, normal and bad, correct? So if the market condition is good, okay, tell me what will be P1? P1 will be 115, correct? D1 will be 9. So I'll write down here P1 is 115, D1 is 9, P0 obviously is 100. Don't take the 6 rupees, correct? 6 rupees is the value of the debenture. We are only looking at the equity share. So tell me what will be my K? 115, P1 minus P0 plus D1 upon P0 into 100. 15 plus 9 is 24. This will give me 24%, correct? If the market condition, students, next is normal. If the market condition is normal, what is P1? P1, students, is 107, D1 is 5. So I'll write down P1 is 107, D1 is 5, P0 obviously is 100. So my K will be 107 P1 minus P0 plus D1 upon P0 into 100. 7 plus 5 is 12. This is 12%. Everybody following? And what if the market condition next is bad? So if the market condition is bad, my P1 students is how much? 97, and my D1 is 3. So I'll write down P1 is 97. Yes, D1 is 3. My K will be P1 minus P0 plus D1 upon P0 into 100, which is obviously 0%. Correct? So we now have the 3 possible levels of X. We have done so many questions like that, students. Ready? So we have the 3 possible levels of X, and then we have the P's also. Let us find summation Px and then the sigma X. Students, what columns will I make? P, X, Px, P, x minus x bar the whole square. Correct? What are the 3 probabilities given? 0.25, 0.50, 0.25. I'll write down here 0.25, 0.50, 0.25. The 3 levels of x are, okay, 24%, 12% and 0%. Correct? So I'll write down here 24%, 12%, 0%. Let us find the x bar, that is the expected return of this security. 0.25 into 24 m plus, 0.50 into 12 m plus, and next is 0 only. So MRC, this gives me 12%, which means the share is expected to give 12% return, and the deviation, let's calculate, students. So x minus x bar the whole square into P, 24 minus 12 into 0.25 m plus, 12 minus 12 into m plus, that is 0 only. Then 0 minus 12 into 0.25 m plus MRC, and then I root it, I get 8.49%, right? So sigma X comes to 8.49%, which means, students, we have X bar, expected return of this share is 12% and the risk of this share is 8.49%. Till your story is clear. Now, students, let me show you what they are asking you next. They are saying that this company has offered buyback of debentures at face value. So what they are saying, this 6 rupees debentures is there, right? Children, what is the 6 rupees debenture? I'll explain. There is this instrument, okay? In that there is an equity component, there is a debt component. Total market value is 106, of which 6 rupees belongs to debt, 100 rupees belongs to equity. Till here everything is clear. So if an investor invests 106 in the company, do you realize the company gives him this instrument, which means with this guy, this instrument is now there, and this guy's 106 rupees is with the company. Now the company says that we wish to give back 6 rupees, you please give back the debenture proportion. Everybody following? Buy back of debentures. The company wants to buy back the debenture by paying him rupees 6. Till here everything is clear. They are asking you in the question whether to accept the buyback or not. They are saying the company has offered buyback of debentures at face value, whether you want to accept the buyback or not. Students, please let us see what ICAI is saying. It's a theory note. Let us read it, then I'll explain it to you, okay? So from the derivatives practice manual, Indian Capital Market Practice Manual, this question is there. From that particular practice manual, I've put this question in this chapter of portfolio because the probability etc. was there, and I thought it is best to teach you this sum in the portfolio chapter only, right? Students, now see what they are telling you. Now if you see, yes, 12% and 8.49% we had also got, right? That is X bar and sigma X. Don't see that now because we're already done with it. We are only going to focus on the other part. The present market price of the share is 106. Come bonus 10% debenture of 6 each. Hence the net cost is 100. There is no cash loss or any waiting for refund of debenture amount. Now this company has offered the buyback of debentures at face value. There is reasonable 10% rate of interest compared to expected return of 12% from the market. Okay, so I'm reading ahead, explanation I'll do later, okay? Considering the dividend rate and the market price, the credit worthiness of the company seems to be very good. The decision regarding buyback should be taken considering the maturity period and the opportunity in the market. Normally, if the maturity period is low, say up to 1 year, better wait otherwise opt for buyback option. So what they are saying is that, see, you have this debenture as well as the equity share, correct? Now they are saying that from the debenture, reasonable 10% interest you are getting, correct? Where are they mentioning 10%? Can you see this? 10% reasonable interest rate you are getting, and as far as the equity share is concerned, 12% you are getting. Yes, you are getting more than the debenture in the equity, but do you realize in the equity there is a slight risk also, whereas this 10% is virtually risk-free. Everybody following? So this 10% interest rate, students, that this debenture is offering is almost risk-free. That means for zero risk you're getting 10%. On the other hand, for 8.49% risk you're getting 12%. See, 12% being higher than 8.49, it is good. I'm not saying the equity is bad, but then don't say that the debenture is also bad because it is giving you 2% less than the equity share. No, because for this 10%, do you realize no risk actually, correct? It's virtually risk-free. So they are saying, considering the dividend rate and the market rates, the credit worthiness of the company seems to be very good. Credit worthiness means the company's ability to repay the debentures, the interest on time. Okay, if the credit worthiness is low, which means we say that the default risk is high. The company might or might not give me the interest on time. It might or might not give me my principal back. That is called as low credit worthiness, high default risk. But you are considering the fact that the equity share is also giving you 12% return with only 8.49% risk, whereas without a risk it is giving you 10% return in bonds, debentures. Do you realize this credit worthiness appears nice? So they are saying the decision regarding buyback should be taken considering the maturity period and opportunity in the market. So they are saying that if you want to accept the buyback offer, accepting the buyback offer means what? I tell the company, no problem, take this debenture back that I have and give me my 6 rupees back. This should be accepted only and only taking into consideration opportunity cost outside and the maturity period. What does that mean? Opportunity cost means what? I will accept the buyback means, do you realize I will get my 6 rupees back from the company? What to do with that 6 rupees? Right now that 6 rupees is there with the company earning a 10% return without risk, correct? Now outside if you're getting something better, then you accept the buyback offer. Opportunity cost is good, accept the buyback offer. This is one way of seeing. Other way of seeing is maturity period. Let's say the maturity period of that particular debenture is 5 years. You feel that in the 5 years period the company will default. It will not give me my money back. Then please accept the offer right now. Accept the buyback offer right now. Take the money home and you're out. Your money is safe. But if you feel that in that maturity period the company will not default, then why are you accepting the buyback offer? Let the money stay with the company. You hold the debenture till the maturity. Everybody following? So normally if the maturity period is low, say up to only 1 year, better wait, otherwise opt for buyback option. So they are just giving a recommendation. They are saying that if a low maturity period is left, only few months or let's say 1 year is left, then what buyback you are doing? Let it be with the company. In 1 year at least you can understand, right? That considering the fact that today it is giving 10% in debentures, 12% in equity shares, 1 year at least it won't default. 1 year at least it won't default, right? So you let it be with the company. But if you feel that long maturity period is there, beyond 1 year, if the maturity period is there and you're not able to see how much default risk is there in the company, then if you're unsure about the company, then accept the buyback offer. That's it. Nothing much in this question. Yes. So students, I hope you understood this particular question, question 93. First we analyzed the equity share alone and then we analyzed the buyback of debentures option. Yes. Thank you very much, students. I will now flash the solution of this question on your screens. You can pause the video and copy down the solution. See you in the next video with another question. Thank you very much.